Welcome to the ARMR Report and our morning meeting. I'm Brett Rosenthal. We're going to be talking about getting ourselves ready for the trading session today, whether it be day trading or swing trading or investing. We're going to cover the gambit. I'm going to go over with you real quick first our trading posture of what we think we'll be doing when it comes to our day trades. Then we'll go over some of our investing posture and how we're viewing the market opportunity we have right now, and if there is one. And we're really going to go over there's three lead indicators for us, certainly from a day trading standpoint, but it also affects investing. And that's really the crypto space, Tesla, and the small cap index. Those are the three canaries in the coal mine. Okay. So if we watch those closely, they give us real lead on direction. And I think it's something that you may find valuable. So don't forget, I'm sharing with you the ARMR Investing Way. This is how I run my own personal capital. Been doing it over 30 years. So I'm sharing with you really a three-step process, fairly simple. We do research on companies. We put those names on the whiteboard. We use algorithms to determine when we add or subtract capital to the market. And we use stop losses to protect ourselves. So let's dive right in. Don't forget, this is my journey. I'm sharing it with you. You got to do your own due diligence, your own research, figure out your own risk tolerance and all those things before you execute anything you hear on, this conversation or any, quite frankly, any conversation you hear. Okay. So here we go. Step one, first thing I wanted to go over, and, for ARMR insiders, I always write in the morning the captain's log first, and I, just my notes on, what I'm thinking. So we're going to go over trading posture first. And let's just take a quick view of the indexes as I chat with you, okay? So step one, we're looking at the big four indexes. So the ARMR risk monitor is yellow right now. It's not giving us an opportunity to get green. It's not showing us any confluence. I talk about that as a problem. So while the big four indexes, the Dow, even though that looks like a rising wedge, is certainly rising. The small cap index has tried to make a double bottom at the bottom of this 11-month channel and is attempting to go back above the standard 200-day and the exponential 50-day moving average. It got rejected yesterday. And then, of course, we have the S&P put in that double bottom right here. And I guess it's time to change this color so you all can see it, because right here we go yellow, and it's kind of a delayed reaction. Not nearly as attractive as an entry point, because we really went yellow here. And we try not to do that. We try to get, green at cheaper prices. Oops, that's not what I wanted to do. So, okay, that's a yellow setup. We got yellow here. Market went down for a couple of weeks, popped back up. We go yellow again. The green entry points are down here. Very smooth, very clean. The entire spectrum of the 7 indexes we follow all go bullish at once, and we get that rip higher. That's not what we're seeing right now. We're just seeing massive volatility, trading inside of a range. Meanwhile, secondary indexes like the IBD 50, are suffering, major declines. And even this rally here after that destruction is simply a bounce back to major overhead. So, of course, we round out with the NASDAQ 100, and it's bumping its head right up against the top of its channel. So not your favorite place to get long the market, but as you recall from yesterday's meeting, we shift to risk monitor yellow. We have to, because 4 big indexes are all communicating, saying the market's probably going up. So what do we do with that information? Let's talk trading posture first. We ran right up to call walls yesterday. So it's my opinion, and I try to keep guesses and opinions out of this, but I do want to share with you what I think is happening. And then always remember, our job is to read and react. So for what it's worth, we're not seeing institutional money get put to work in the last 2 weeks of the year. Institutions are on vacation. We can see this in the volume numbers that have just fallen off a cliff in the last couple of weeks. During the market rally, volume has gone like this, straight down, okay? So what you're getting is an options-induced rally into the end of the year. Could spill over in the next year. It's the proverbial tail wagging the dog. And it turns the big indexes positive because that tail, where there's huge options activity in the S&P and the NASDAQ and whatnot, can drive the big indexes higher. But right underneath the surface, the rest of the market, the broader market, massive destruction. I mean, like, you try to put trades on in the morning, stocks are down 5 and 10% by the end of the day. You know, what looks like good stories, here's a cautionary tale. You know, you can just take a look at Digital Turbine as an example. I mean, this was a really great story. They cut a deal with Google. It should be great. Stocks up 11% in the morning and down almost 2% by the end of the day on massive volume. I mean, that's somebody, you know, taking good news and getting out of Dodge. So that's the type of market that we're in. There's about 7 big cap stocks that are driving the market higher. And it's really a Vanna-induced gamma type of rally. So how do we trade that? One very important step of whether or not the market goes higher was to see the call wall roll higher, because in my opinion, this is an options-driven rally right now. This is not an investing-driven rally, okay? So you've got to see call walls roll higher, and if they do, there's room for the market to keep going up. That's what that tells you. So we saw the call wall roll higher in the last couple of days on the S&P. We didn't see it roll higher in any of the other indexes. Today, we see it roll higher in the NASDAQ 100. So we went from 400 on the Qs, okay, to up to 410. So that's a confirmation. So now we got confirmation that the call walls are rolling higher. So instead of, you know, what's been 400, all up here has been limited because the market has run right up into that call wall and gotten rejected. Now that roll has rolled higher, and it's now trading above the top of this range, okay? So once we get some confluence, couple indexes, probably the market's going higher. We have positive gamma. In a positive gamma market, you usually get smaller volatility moves. So the way I'll be trading today is I'm looking to trade crazy Ivans. Those are the best setups in a market like this. In a positive gamma market where volatility is compressed on the big indexes, not individual names, big indexes, what you need to see is weakness in the morning that sets up a reversal pattern. You buy the reversal trigger. You enjoy the melt up higher towards the call wall. That is the number one trade I'm looking for, okay? And I'm talking about index trading now. So first thing we'll do on the live trading desk for subscribers, ARMR Insiders, is we're going to go to our screen of the big indexes. And this right here is a 3-minute chart. These are all 3-minute charts. So every bar is 3 minutes. And what we're doing is we're looking at the NASDAQ 100 right here. And so this bar right here is, right here is 400, okay? And this 400, which was the call wall before, is going to move all the way up to 410 now. Okay? So there's room to run to 410 on the Qs now, right? So what happened yesterday is the Qs got dragged down towards the call wall. They were trading above it, dragged down towards it, but stayed above it, and enough calls have been bought to drive that thing up to 410. Over here's the S&P. You can see that purple dash right here. This is spot gamma information now. And you can see it's at 480. So both these indexes, although they've had a nice run, the call walls have rolled higher, which means there's room for movement higher in the market. So what we're looking for is a weak open or some type of selling early. Then we look for ARMR reversal triggers, get that trigger, put the money to work. Now, I just want to talk to everybody who's trying to day trade and goes through a period where they're not getting it right. I want to offer you some thoughts on this. Number one, and so every trader goes through this. Every trader is going to go through a period where you take some losses and you start to question what it is that you're doing. Or you find yourself only engaging in trades on days where you have the courage to do it. Those are the days the market goes down, you lose money. Then you decide to stay out. And of course, the next 3 days, there's unbelievable opportunity on the upside, drives you crazy. So on day 4, you know the story, okay? So what I submit to you is these following thoughts to help you develop as a trader. Number one, you have to accept some losses. You cannot beat yourself up because you have a day where you lose money day trading. There's not a system in the world that's going to make money 100% of the time. Right? And even those systems that think they make money 100% of the time, like long-term capital management, end up running into a buzzsaw and losing everything because they get arrogant. Okay? So there aren't systems that make money every single day. You have to understand going into it. Your mindset has to be, I'm following a strategy. I believe in the probabilities and statistics. I can see that this strategy works if I execute it. The single biggest problem for traders is that they have a system that they don't execute. Then they blame the problem on the system instead of recognizing that they're not executing correctly. Okay? It happens to all of us. So the first thing I would wish to tell you is accept a day of losses. The idea on your losing days is to keep the losses small. For my strategy, I can tell you my biggest weakness, okay, is that even though I see it, even though I know this to be a fact, which is when trading the indexes, when we get our setups, we put the money to work, we make money right away. The good trades never challenge the stop. Okay. The minute a trade is challenging the stop, it tells you this is not the right day to trade for the system that I run. Okay. So you take your loss quick and you stop trading. Okay. I allow myself one extra trade. So if I put a trade on and I get my stop hit quick, because I have tight stops, because I know most of my trades, not most of them, all of my great trades never challenge the stop. Put the trade on, thing skyrockets. That's the day I'm looking for. So I put a trade on. I have very tight stop for half of my position, and a little bit larger stop for the other half. If I get stopped out, I'll put one more trade on that day because there might be a setup a little bit later in the day that shows up. Is okay, this is worth putting another trade on. But that's it. What you don't want to do is overtrade your account on the day where you're not making money. It's just not your day. Accept it. Your system for that day, not your day to make money. So keep your losses small. Okay? Allow yourself to have losses. Don't think unrealistically that it can't happen. Okay? As a good trader, you have to have no memory of yesterday. Can you do that? It's like being a goaltender in hockey. Some of the greatest goaltenders, they get blown out on a particular night, and the next day they come right out and they pitch a shutout. They don't think about what happened the day before. It's totally different. We've got a completely clean slate today. Don't let that disappointment of yesterday work its way into your decisions today, because you're already dead if you do. Your decisions should be systematic. You got the playbook, you got an entry point, you put the capital to work, you have your stop, you exit, you're done. That's it. Asset runs higher, you book your profits, you have a great day, you cheer. That's it. Then you start again the next day, having no memory of the day before. You got to do that, okay? You got to trade what you see. You don't guess, you don't second guess. That's just fear talking, right? So you're going to see your system set up, and then you're going to start talking yourself out of it. Well, this could happen, that could happen, blah, blah, blah. You have CNBC on. God forbid that happen. Turn off CNBC. That's just a guaranteed way to lose money constantly, okay? So trade what you see and put on blinders, okay? I like to say that if you run into a patch where you're struggling, drop your position size and stay at that position size for 10 trading days. Chart your performance. Don't have one good day and then triple your position size the next day. You need to build confidence in what you're doing. So work with a position size that you're comfortable with, where you can execute your strategy to the correct stop, and do that for 10 days in a row and look back at your 10 days of trading. What's my performance? Out of those 10 days, how many days did I make money? Was I executing correctly? If you can look back and say, yep, I did everything I was supposed to do. I didn't let the day before get in my way. I simply executed the strategy and you were successful. Then you can increase size again. And of course, the last thing you can do is start paper trading. For a couple of days, just stop trading completely and start putting it down on paper. I would buy here, I would sell here, see where you are at the end of the week. Yep, you're back into the rhythm correctly, and then you can start putting money back to work. So those are my thoughts for traders to get yourself back in the game if you're struggling at all. Let's move on to investing posture, okay? I've been bearish really for the whole month of December. And for the number one reason is the risk monitor was red. So that was no brainer. I was bearish. Market had a lot of volatility. Now the risk monitor turns yellow, which is not bullish. It's just me acknowledging the fact that the biggest indexes and the biggest tech stocks are going higher right now. So there may be a window of opportunity to make some money on the swing side. There's such a torrent massive amount of bearish bricks that can go in the wall of worry. I really have a hard time putting money to work right now. And I try to get that out of my mind because the market climbs a wall of worry. And all of these things that I think are horrible about the market, they might not manifest themselves for 3 months. So I'm not going to sit here and do nothing. But it does temper my enthusiasm. And so I trade less, I invest less. But I stuck my head out of the shelter yesterday, put some money to work early in the morning, and I was not treated well. You have to read and react to these things, okay? When you put some capital to work and you're not treated well, in a risk monitor green signal, you put capital to work, everything is popping off. Bang, bang, bang. You're just making money everywhere, okay? So when you start to put some capital to work and it's tough. It's tough. You have to recognize that. So I've put some positions on. Some of them didn't make it. So by the end of the day, I was out. And I have a handful of positions that I'm sticking with right now. They're all commodity related. Not because I'm trying to go to commodities, but because those are the chart patterns that are setting up right with the right risk on ARMR Algos, single stock algo buy signals. So those are the stocks that I'm buying. They happen to all be commodities. That does sync up with my opinion that 2022 could be a big year for commodities. So I'm going to obviously stay with those names to the correct stops. I can go over some of those with you real quick. The steel stocks were just, as a group, I had to own these names. The time to own the steel stocks is when nobody's talking about steel stocks. And they've quieted down. They've made this perfect double bottom at the 200-day. If that double bottom breaks, they're all going down. I'll be gone. I'll be out. Okay. But the entry point was yesterday on these names: Cleveland Cliffs, U.S. Steel. Okay. You can see the patterns are exactly the same. Big run up all year, double bottom over the last couple of months, making a bottom right at the 200-day. Okay. Nucor, of course, is the leader. With the pattern of, it looks like a kind of a high pennant in here. Okay. Steel Dynamics. These are my favorite 4 steel names. You could own a steel ETF, but I don't want all the other ones. I want these 4. And they all have basically the same patterns. So either these double bottoms are going to hold and these things are going to break out and we're going to have a move on commodities. So I follow that with a couple of big Dow stocks that I think are the reward to risk is right. I've been following Deere for a long time. If it stays above that stop right here, which is the low of that bar right there, I stay with that trade. Okay. These are lower volatility names. Not the steel stocks can get wrecked in a day. So they're not lower volatility, but Caterpillar, Deere, these are big cap Dow type of names. Okay. After making big retracements and big bases, they are coming out of those bases. Now, I've been on the conference calls. I've listened to the earnings announcements. These companies have backlogs, larger than any time in history. The demand for their products is off the chart. 2022 should be another great year for earnings for these companies. And if it's a commodity-driven year, which I think it will be, I don't want to get lost in the weeds right now about inflation and what the Fed's doing and all that, but let's just say it looks like a commodity year to me. So I'm going to run with those names for right now. XOP, I'm going to be long the U.S. exploration and production companies. Now, I know a lot of you want to buy the individual names. I'm just telling you, in this market right now, I'm in case you didn't already realize it, I'm uncomfortable with the market, right? So I don't want a whole bunch of individual names. So I'm not going to go buy all the small cap E&P companies. You could make a lot of money on them. If this thing works, they're all going to skyrocket. But I want to try to avoid retail stocks. No matter how great the story is, if it's a retail Reddit meme type of name, that retail investor is getting slaughtered this year. Okay? Firepower gone, right? I need to find names where institutions can support the names. So institutions aren't going to support a small cap E&P company. I don't need that risk. I'd rather, if I wanted more exposure to E&P, I'd rather own XOP and probably put twice the position size on. Give me more exposure, but not any single stock risk. In a market like this, if there's a company that makes one bad piece of announcement or whatever, stock gets destroyed. I mean, there's just no bids. I don't need that risk. So I'm going with the ETF, okay? I'm not even going with, Gush, but I mean, Gush is something that could be traded probably intraday, which is triple the XOP. There's a way to get massive outperformance without any single stock risk. But of course, you got to deal with the triple risk. I don't think you need it. I mean, XOP can jump 5% on a day all by itself. Do I need it to jump 15%? I mean, how much risk do we really need to take? I feel that the market, because of what happened in 2020, people are learning a valuable lesson this year that you just can't put that amount of capital to risk in an idea to try to make 15% in a day. It's like, that's not investing. I don't want to get off on the weeds. Anyway, so I'm going to stick with those names. I'm looking for names to fill out my dividend portfolio. And I got to be honest with you, I've been looking long and hard at this. And I think Mo is really going to appreciate it. I think it's Mo, right? I think ID Doc, this is something you've asked about before, you talk about before. If it's not Mo, it's somebody else, forgive me. I'm starting to really consider BHP again at a 10% yield. Is that yield right? I got to go look and see what the dividend coverage ratio is to make sure they can service that dividend. But a 10% yield in a year where we go into a commodity market, with BHP having sold off down to this basin here, making a double bottom right here and trying to come out above the 50-day now. God, BHP and Rio Tinto at a 10% yield. These two stocks run together. I mean, people like to, I like this one more than that one. At the end of the day, guys, they both do the same thing. So I'm not going to buy Valley. I'm not doing Valley at a 20% yield. Something's not right with that stock. I'm not touching that. But Rio Tinto and BHP at 10% going into a year that could be a commodity-backed year, that's starting to look like a really interesting addition to my dividend portfolio. It's higher risk, but how would you like to capture that upside principle-wise and collect 10% while you do it? That would just be like a home run next year. So I'm looking real close at those names. So anyway, that's where I stand today. I'll be trading the indexes as always. So anybody that's joining us on the live trading desk, we'll start that at 9:15. I've got about 6 minutes for some questions. Anybody got some questions? I'm happy to take them. ARMR Insiders, anybody out there wanting to discuss a particular issue, you just let me know. All right, let's see. All right, Robert wants to take a peek at CHV. CHV, I'm not sure what that is. This Cisco is just in absolute skyrocket mode. What a chart. What a run. I won't touch that, you know. I'm just not chasing. I'm not chasing in a market like this. I'm trying to find stocks in basis, and I should have been buying it right here at the 50-day, and I didn't. So I can't chase it now, but it certainly looks good. What's the put wall on the S&P? Put wall is far away on the S&P, and I worry less about it. Put wall right now is on the SPY is 455. You know, we're at 480. On the S&P itself, it's down there at 4,400. Okay, so I'm not so concerned about the put wall right now. Obviously, I like to buy at the put wall and sell closer to the call wall, but you don't just sell the call wall, because when the call wall starts rolling higher, you get into a market that's kind of melting up. And so every day you get in a positive gamma market. Let me put it this way. Buying the put wall is a money trade, and I try to do it every time. Okay. Selling the call wall doesn't work like that. You get up to the call wall, volatility compresses, you're in a positive gamma environment. Then you wake up in the morning, the call wall's rolled higher and the market goes higher again. So you don't just short the call wall because you're at the call wall. Okay. And anyway, the put wall is way, way, way down below. And it doesn't really matter, because if the market reversed and started to sell off, you'll start to see the put wall roll higher. And we can worry about the put wall when the market starts going down. Don't worry about it right now. You're thinking of the next move to the put wall. That to me, this is my personal opinion. That's not a thought for this moment in time. When we're in a positive gamma environment and the call walls are rolling higher, we just trade that trend, right? Until that stops, market starts going lower. Then we start saying, okay, where's the put wall? You see what I'm saying? But there's no way to try to guess when we're going to get a rundown to the put wall. When it starts to happen, you'll know. There'll be a series of down days, and then we'll start saying, okay, where's the put wall? Where can we buy this thing? And it'll move. It'll move from where it is now. It'll definitely change. January vertical call spreads expiring. What are your thoughts, Robert? I don't do any type of vertical spreads. I don't trade options like that. I trade options very infrequently. So I'm a believer in becoming very good at one thing and executing that one thing really, really well, and not spreading yourself too thin. And so what I do at the ARMR report is try to offer information on the indexes, on stocks. And I find a lot of people that are ARMR insiders use that information to trade options. That's great. But I'm going to leave the option decisions like that up to you. It's a huge coffee mug. It is, right? Amen, man. I need my coffee every morning. I can't function without it. Oh, CVX. I thought you were going to. Yeah, I got my eyes on CVX and Exxon. These are 5% yielding stocks, and they should be in the portfolio. And again, I should have owned them right here. But it's like, Robert, that's why I like the steel stocks right now. Or that's why I like BHP right now. Buying BHP in the steel stocks is literally like buying CVX, okay, right here. Okay, close to the double bottom, close to the stop, close to the moving averages. I should have done that. I mean, I should be on CVX, and I'm not, and it makes me a little sick, I'll be honest with you. But I would own this for the dividend, not necessarily for an option spread. But again, that's up to you. I mean, that's kind of your bailiwick. Exxon looks pretty good too. And that's a 5.5% yield. And that's actually close to the move. Look at Exxon. Ooh, Exxon at 5.5%. That's the cup and handle setup you want to see. Boy, Exxon, look, I got to write that one down. Exxon should probably be in the dividend portfolio. You see what I'm saying? I'm trying to buy things close to the double bottoms, close to the moving averages. And so when they pop, I'm already making money and I'm collecting a 5.5% yield. All right. Everybody, thanks for joining me for the morning meeting. I look forward to seeing all ARMR insiders in the Slack room right now. We'll start chatting, sharing information, and the live stream for the screen share where we walk through our step-by-step process of how to trade indexes using spot gamma information begins at 9:15. I'll see you all there. Everybody else have a great day trading, and remember to stay nimble. Don't force your will on the market. Stay nimble, my friends. Take care.